Imagine waking up to see your currency drop 10% overnight. Your savings didn't move. Your work didn't change. But everything around you just became more expensive. Fuel, food, rent. In a world built on debt and confidence, that is how recessions begin now. Not with a stock crash, not with a housing bust, but with a sudden fracture in the money you use every day. Tonight, we're going to trace the fault line that runs beneath the global economy and show why the next recession will start with a currency crisis. First, the promise. This isn't another doom loop. It's a map. If you know where to look, at balance of payments, the interest rate differentials, the FX basis, the soft pegs hiding in plain sight, you can see the tremors before the earth moves. Let's start with a simple truth. Economies don't run on cash, they run on credit. And credit runs on trust. Currencies are the operating systems of that trust. When a currency is stable, businesses plan, investors hold risk, and households keep spending. When a currency wobbles, everyone moves at once. Companies hedge, banks shrink balance sheets, importers hoard dollars, households cut non-essentials. Demand falls. Investment pauses. Liquidity dries up. That sequence is a recession triggered not by GDP data months later, but by the moment FX volatility explodes. Think back to the last decade. We saw sovereigns try to keep currencies steady with small interest rate tweaks, forward guidance, or subtle interventions. It worked until it didn't. Underneath, debt loads rose, current accounts swung, and the world became addicted to cheap dollars. Companies borrowed in currencies they didn't earn. Consumers took out loans tied to benchmarks they didn't understand. Banks built layers of derivatives to smooth the ride. As long as volatility stayed low and the dollar stayed generous, the machine purred. But volatility is not a number. It's the sound of everyone heading for the door at once. So why will the next recession begin in FX? Because the pressure points have migrated. Inflation forced central banks into a new regime, higher rates for longer. That raises the cost of rolling debt and splits the world into currency winners and losers. Capital flows toward yield and perceived safety. Countries with soft pegs or large external financing needs have to defend their currencies with reserves or with interest rates that bruise growth. If they fail, the currency slides, imported inflation spikes, and policy is trapped. Tighten and crush the economy, or ease and feed the spiral. Neither choice is friendly to growth. Picture 3 dominoes. Domino 1, a currency with a current account deficit and a reliance on short-term external funding. Domino 2, a corporate sector with foreign currency debt that isn't fully hedged. Domino 3, a banking system exposed through cross-border wholesale funding. Strike the currency, it hits corporate balance sheets. Corporate stress hits banks. Banks pull credit. Investment stops. That is how a move in FX becomes layoffs on Main Street. But let's make this tangible. Imagine a country with a shiny technology sector and a hot property market. Cheap global money flooded in. Developers borrowed in foreign currency because it was cheaper. Export revenues covered the carry until global rates rose and the currency softened. Suddenly, refinancing costs jumped. The developers needed more domestic currency to buy the same amount of dollars to service their loans. They sold assets, delayed projects, laid off staff. Banks, seeing rising non-performing loans, tightened lending standards. Households, feeling poorer as prices rose faster than wages, cut back. GDP didn't cause this. The currency did. You'll hear people say, well, just hedge. But hedging is not free. And when everyone tries to hedge at once, basis widens, costs surge, and counterparties raise margins. Liquidity evaporates precisely when you need it. The FX market is deep until it isn't. And because so much trade, energy, and debt is priced in a handful of reserve currencies, stress concentrates where the pipes are thickest. The moment a country's authorities burn through too many reserves defending a level, the market smells blood. It doesn't want a price. It wants out. There's another layer, politics. Currency crises erode trust in institutions. They arrive with headlines and cues at exchange counters. They provoke sudden, theatrical policy moves, emergency hikes, capital controls, surprise devaluations, dual exchange rates. Each move solves a day and harms a year. Businesses reprice contracts weekly. Consumers front-load spending before prices rise again. You can feel the recession in the shape of the day. So what sets the spark? Often, it's the ordinary, a larger-than-expected trade deficit, a missed refinancing, a scandal at a major lender, energy price shock, a data release that shifts rate expectations. Sometimes it's the extraordinary, sanctions, war, a natural disaster. But the mechanism is similar, a jump in the demand for a safe currency and a fall in the willingness to supply credit to everyone else. Listen to the rhythm of these crises. First comes the FX move. Then volatility spikes across rates and credit. Then equities fall, not because the story starts in stocks, but because earnings do not like recessions and recessions follow credit. If you wait to react until equities are down 20%, you're late. The leading indicator in this cycle is FX stress. How do you measure it? Start with the current account. A sustained deficit means an economy must attract capital every day. Watch reserves, rapid declines signal defense. Track the real effective exchange rate. An overvalued currency bleeds competitiveness. Examine the maturity structure of external debt. Short maturities mean constant refinancing risk. Monitor the spread between onshore and offshore rates and the FX forward points. Distortions reveal pressure. Look at cross-currency basis. When it widens, the scramble for dollars has begun. And watch the policy rate relative to inflation. Negative real rates can trap a central bank between growth and credibility. Energy is the amplifier. When energy is dear and a nation is a net importer, a weakening currency raises energy costs again, which raises inflation again, which forces policy again. That loop is why currency crises rarely stay small. They move through fuel into freight, through freight into food, through food into politics. But there's a twist. In the past, currency crises were mostly an emerging market story. Today, balance sheet mismatches and external dependencies reach far wider. Advanced economies are not immune. They are simply more leveraged, more interconnected, and more confident. Sometimes confidence is the risk. Consider the quiet soft pegs in the global system. Countries that say they float but spend reserves to keep ranges. Corporates that rely on constant access to cheap hedges. Banks that assume central banks will always provide swap lines fast enough. When a shock hits, policy support may arrive, but not in time for everyone. Markets move by hours. Policy moves by meetings. Now let's trace the path from FX to the real economy. The currency slides. Import prices rise. If wages don't keep up, real incomes fall. Consumers cut discretionary spending. Retail slows. Firms facing higher input costs raise prices selectively and delay capex. Banks tighten loan terms. Refinancing risk increases for weaker companies. Defaults tick up. Investors demand higher spreads to hold corporate debt. Equity valuations compress. Unemployment lags, then jumps. This is the recession, an adaptation to a new, harsher price of money. Could governments cushion the blow? They try. Fiscal transfers, tax cuts, subsidies on fuel or food. But markets price credibility. If stimulus is debt-financed in a country already facing external pressure, the currency slides further. If authorities slap on capital controls, liquidity shrinks and parallel markets appear. The economy becomes less efficient precisely when it needs agility. So where might this start? It starts where three conditions overlap: external deficits, heavy short-term foreign liabilities, and fragile policy credibility. It starts in countries that import energy at the wrong moment. It starts in economies whose growth model requires a strong currency to service foreign debt, but whose politics require a weak currency to support exports. It starts where central banks must choose between inflation and employment and cannot solve both. For investors and business leaders, the imperative is clear. Stop treating currency risk as a footnote. It is the headline. If you run a business that imports critical components, assume FX will move faster than your procurement cycle. Build buffers. If you finance in a foreign currency, hedge further out than you think you need, and know your margin call liquidity. If you allocate capital, stress test against 20% currency moves in a year of high carry. If you're a policymaker, communicate early and plainly. Don't promise lines in the sand you can't defend. Anchor expectations with rules, not miracles. There is also opportunity. Currency crises eventually reprice assets brutally and efficiently. Companies with domestic revenues and foreign currency costs may suffer. Exporters with foreign revenues and domestic costs may thrive. If you can't survive the squeeze, Devaluations can reboot competitiveness. But this is cold comfort when the squeeze crushes demand. The anatomy of the next recession will look like this: a period of deceptively calm data as lagging indicators still glow, a sudden flare of FX stress in one or two vulnerable economies, a reflexive tightening of global financial conditions as the dollar firms and hedging costs jump, a string of corporate warnings citing FX and input costs, a policy scramble, then the slow recognition that growth has already turned. By the time recession appears in headlines, the FX charts will have already told the story. What about reserve currencies? Aren't they safe? Safer, yes. Immune, no. Reserve currencies benefit when fear rises, but that strength itself can tight conditions globally, boomeranging back through trade and earnings. Even for the anchors, a too-strong currency hurts exporters, compresses profits earned abroad, and triggers political pressure. The safe harbor can become a headwind. And what about digital assets? Some believe they're a hedge against fiat fragility. In a genuine FX panic, correlations can flip. When margin clerks run the world, anything liquid is for sale. Later, narratives return. In the moment, cash is king and the dollar is gravity. If the next recession begins with a currency crisis, what ends it? Time, painful adjustments, and credible policy. Balance sheets must be repaired. Foreign debt reduced. Reserves rebuilt. Relative prices reset. The calendar of recovery is measured in policy credibility and external financing, not in quarters on a chart. So, what should you watch tomorrow morning? Watch the current account updates. Watch reserve changes. Watch the spread between official and street rates where they exist. Watch the forward market for signs of fear priced into the curve. Watch energy prices versus the currencies of importers. Watch credit default swaps on banks with cross-border funding. Watch the policy language for hints of defense. And what should you do tonight? Take your balance sheet and flip it into FX terms. If your revenue falls 10% in foreign currency terms, what breaks first? If your costs jump 10% because your currency slides, which contract can you renegotiate? What's your liquidity if your hedge requires more collateral? The economy is an average. Your business is not. Build for turbulence. There's a final myth to puncture, that currency crises are rare and theatrical. They are increasingly common and stealthy. The market accents change. Sometimes it's a crawl, sometimes it's a cliff, but the destination is the same, a new price of money. If you can see that price coming, you can act before the crowd. The next recession will not introduce itself with a bell on a stock exchange. It will arrive in the exchange rate, in the quiet widening of basis, in the politician's midnight press conference, in the importer's frantic phone call to the bank. It will begin where the world's promises meet the world's invoices, the currency. Understand that, and you understand the modern business cycle. Here's the uncomfortable comfort. Systems adapt. The pain is real, but so is the learning. Policymakers who preserve credibility will emerge stronger. Companies that manage currency honestly and early will win market share on the other side. Households that keep buffers will sleep better. Crises reset. They also reveal. If you remember one thing, remember this: recessions are born from tightening money. In a globalized, leveraged world, money tightens through the foreign exchange channel first. When currencies break, credit follows, and when credit follows, growth stalls. That's the order of events. That's the map on the wall. Stay curious. Watch the pipes, not the paint. And never mistake a quiet currency for a safe one. If you found this breakdown valuable, don't forget to hit that like button. It tells the algorithm this story matters. Drop a comment with your thoughts on where you think the next currency flashpoint might emerge. Share this video with someone who needs to understand how the next recession will really begin. And if you haven't already, subscribe and turn on notifications, because the next big episode could drop before the next big move.